Welcome to the deep dive. Today, we're really getting into the details of a key document from, well, a major global player, excerpts from Boeing's 2024 Form 10K annual report.
That's right. And our goal here is to kind of cut through the official language.
Exactly. We want to understand their business, how they actually performed last year, the challenges, the real ones, and, where they say they're going, straight from the source.
And you mentioned that number up front, the backlog. It's huge.
Over $500 billion. It just jumps out. It signals this massive future potential, but I mean, it sits right alongside the significant turbulence they clearly faced in 2024.
That half trillion is definitely the demand side picture, yeah. But this document, it really lays bare the struggle they had in 2024, actually turning that demand into, delivered planes and services. That's the core challenge.
Absolutely. This report gives us that detailed look, the friction points. So let's start with how Boeing is positioning itself now, its goals, especially with all the scrutiny.
Well, the CEO's message seems pretty direct on that.
Yeah.
The foundational focus, they say, is safety, quality, culture, and people. That's the bedrock.
Okay.
Their stated mission is broad: connect the world, protect freedoms, support the global economy. But the goal they spell out is interesting. Getting back to the Boeing that revolutionized air travel and pushed the boundaries of innovation.
Getting back to it.
Yeah, it implies an acknowledgement, right? They also mention implementing fundamental changes to stabilize things, improve the culture, restore trust. It feels like a clear signal. Fixing internal ops is priority one.
Okay, so how is this giant operation structured? According to the report, what are the main sort of business engines?
It breaks down into three main segments. First, commercial airplanes, BCA. That's one most people think of.
Passenger jets.
Exactly.
Yeah.
Designing, building, selling, servicing those commercial jetliners. They highlight being a leader in the 100-plus seat market.
Got it. Second.
Defense, space and security, or BDS. This is all the government and military stuff. Research, development, production of military aircraft, weapons, defense systems, intelligence systems, satellites, even space exploration tech.
And the third piece.
That's global services, BGS. Basically, providing services and support for, well, both the commercial and defense products. Think maintenance, spare parts, training, data analytics, modifications.
And it's a global operation, right?
Very much so. The report emphasizes principal operations are in the U.S., but they lean heavily on this extensive international network of partners, suppliers, subcontractors.
Okay, let's dig into the numbers then. How did these segments actually do in 2024? What does the report tell us about trends and, importantly, the challenges in each?
Right. The 2024 revenue breakdown. BCA brought in $22.9 billion. BDS was actually a bit higher, $23.9 billion. And BGS added $20 billion.
So total revenue.
Total consolidated revenue was $66.5 billion. Now, compared to 2023, that's a pretty significant drop from $77.8 billion.
Wow, okay. And the segment breakdown of that drop?
The report shows BCA revenue was down quite a bit year over year. BDS was also down, but only slightly. BGS, interestingly, saw its revenue go up.
So the commercial side, BCA took the biggest hit. The report talks about a highly competitive market. Was it just competition, or what were the big operational issues hitting BCA in 24?
Well, the market is competitive, no doubt. Airbus is the main rival, and there are new Chinese entrants mentioned. And demand always depends on, the economy, airline profits, fuel prices, things like that.
Sure.
But the report makes it pretty clear. The revenue drop in BCA wasn't just about market demand. It was heavily impacted by internal issues and the supply chain.
Ah, okay.
They specifically call out ongoing supply chain constraints, labor instability, and inflationary pressures. And these hit both Boeing's own factories and their suppliers. These problems directly cause slower production rates, especially on the 787 and the 776 programs.
And slower production means?
Fewer deliveries, which hits revenue recognition hard on these long-term contracts. It also caused significant delivery delays. The report notes the 777-9, it's now pushed to 2026.
2026.
Yeah. The 777-8 freighter is delayed to 2028, and the 777-8 passenger version, well, not before 2030.
Oof. Any other production issues mentioned?
Yes, they detail production and rework problems, specifically about 25 inventoried 787s, planes built before 2023, needed significant rework. That cost them $256 million in expenses in 2024 alone. They do expect to deliver most of those in 2025, though.
And what about paying customers for these delays or issues? We've heard things.
The report quantifies some of that, yes. They mentioned $109 billion in customer concessions just for 737 AX issues in 2024. And crucially, there's a $443 million charge listed.
$443 million.
Yes, and that's net of insurance. It's directly tied to the disruption of the grounding of the 737-9 after that Alaska Airlines incident. They also flag certification risk for new programs like the 777X and the 737-10 as potential future headaches impacting costs and timelines.
Okay, let's pivot to BDS, the defense and space side. How did that segment fare, and what unique challenges does the report highlight there?
BDS, well, it relies heavily on government contracts, especially the U.S. government. That was 42% of Boeing's total revenue in 2024, if you include foreign military sales.
That's a huge chunk.
It is, and it comes with its own set of risks, complex procurement rules, potential changes in requirements like domestic content thresholds, which can drive up costs unexpectedly.
Were there specific program problems hitting BDS's numbers last year?
Yes, this is a really key point in the 10K. A major reason for the flight revenue dip and the overall losses was significant losses on several fixed-price development programs.
Fixed price, meaning if costs overrun, Boeing pays.
Exactly. They agree on a price up front for a complex system. If development costs balloon due to delays, tech issues, supply chain problems, labor costs, Boeing absorbs the hit. The report specifically calls out major issues on 5 programs.
Which ones?
The KC-46A tanker, the T-7A Red Hawk trainer jet, the Commercial Crew Space Program, the new Air Force One, VC-25B, and the MQ-25 refueling drone.
Wow, those are major programs.
Huge. And in 2024, those 5 alone resulted in $909 million in higher net unfavorable cumulative contract catch-up adjustments. Basically, they had to increase their estimated costs to complete these jobs significantly.
And the report says?
It says these losses are expected to hurt future cash flows and could lead to even more charges down the line. They blame things like production disruptions, supplier issues, factory performance problems, higher costs for parts and labor, and even note the impact of having an inexperienced workforce in some areas.
So similar operational problems hitting both sides, commercial and defense, but the fixed price contracts on the defense side really crystallize those losses financially. What about global services, BGS?
BGS looks like the steadier part of the business, according to the report. They see the market outlook as stable. Commercial services revenues should stay strong as airlines recover and grow.
Makes sense.
The U.S. is the biggest government services market, but growth there is expected to be kind of flat. They see more growth potential internationally as non-U.S. fleets add aircraft. Plus, they expect about 30% of the global military fleet to retire or be replaced in the next decade.
Creating demand for services?
Right, for maintaining older planes and upgrading others.
Yeah.
So yeah, BGS seems like a relative bright spot financially.
Okay. Stepping back a bit, the 10K also details broader risks affecting the whole company. What are some of the key ones they flag?
There are quite a few, and they're interconnected. Heavy dependence on suppliers, their performance, their financial health, that ties right back to the production issues we talked about.
Right.
Availability of skilled workers, key materials like aluminum, titanium, composites, that's a risk. Relying on single suppliers for critical parts is another.
What about financial or accounting risks?
They point out the sheer complexity of accounting for these huge long-term contracts. It requires a lot of judgment. And if those estimates change, it can lead to big adjustments or losses. Like that $4.1 billion in reach-forward losses they booked in 2024.
$4.1 billion. Explain that again.
Yeah, that's where they realized their estimated total costs to complete work on specific programs, specifically the 777X and the 767, had increased so much they had to record the expected future loss immediately.
Ouch. Other major risks.
Ongoing litigation, government investigations, those have unpredictable outcomes. Cybersecurity is always a threat. Environmental compliance costs money. And they have very large pension and post-retirement benefit obligations, which can swing their earnings and cash needs around.
That's quite a list. It sounds like it would definitely impact the bottom line. Let's look at the consolidated financials for 2024 versus 2023. What was the overall damage?
Yeah, the top line numbers show it. Total revenues down from $77.8 billion to $66.5 billion. The GAAP loss from operations, that's the loss from just running the core business. Standard accounting, it widened dramatically. From about $773 million loss in 23 to a huge $10.7 billion loss in 24.
$10.7 billion operating loss.
Yes. And the net loss attributable to shareholders, that widened even more, from a $2.2 billion loss to a staggering $11.8 billion loss Per share, that's a loss of $18.36 compared to $3.67 a year before.
Those are enormous losses. What were the main drivers, according to the report?
It points directly to those higher operating losses at BCA and BDS, and it specifically highlights the impact of non-cash items like that big $4.1 billion reach-forward loss charge on the 777X and 767 programs we just discussed.
So with those kinds of operating losses, how did their cash flow hold up? Were they generating cash or burning through it?
This is really critical. The report shows net cash used by operating activities was $12.1 billion in 2024.
Used. So they burned through $12 billion just running the business.
Essentially, yes. Operating cash flow is the money from day-to-day stuff, selling things, paying suppliers, employees. Using $12.1 billion means core operations consume that much cash. The report blames this mostly on the commercial airplane side, slowed production, lower deliveries post-Alaska accident, supply chain issues, a labor stoppage.
And they're still investing, right? Capital expenditures.
They are. CapEx spending on factories, equipment, R&D facilities was $2.2 billion in 2024. That's actually up from $1.5 billion in 2023. And they expect CapEx to grow again in 2025.
So burning cash on operations, increasing investment spending, how do they cover all that?
That's where financing comes in. They brought in a lot of cash through financing activities in 2024, $25.2 billion provided. That's a massive swing from 2023 when they used $5.5 billion in financing.
Where did that $25 billion come from?
Primarily from raising capital late in the year. They issued $18.2 billion worth of common stock net proceeds and $5.7 billion from issuing mandatory convertible preferred stock, both in Q4. Plus, they issued $10 billion in senior notes debt earlier in the year. So they leaned heavily on external financing.
Okay, let's look at the balance sheet then. End of 2024, what's the overall financial health picture look like there?
At year-end 2024, they had $13.8 billion in cash plus $12.5 billion in short-term investments. So roughly $26.3 billion readily available. Total assets were $156.4 billion. But total liabilities were higher at $160.3 billion.
Liabilities exceed assets.
Yes, resulting in negative shareholders' equity of $3.9 billion. Now, negative equity sounds alarming, but the report notes the stock issuances in 2024 actually improved the situation significantly from the end of 2023, when equity was negative $17.2 billion.
So the stock sales shored up the equity position, even if it's still negative. Any other big moves in the balance sheet?
Yes, a really noticeable one. Inventories jumped massively, up by $10.7 billion in 2024.
$10 billion more in inventory.
Yes. The report directly links this to lower deliveries on the commercial side. Basically, they built planes or parts they couldn't deliver and book revenue for yet. They also show a huge number for advances and progress billings, $60.3 billion. That's customer payments received before they actually recognize the revenue. And long-term debt also crept up, ending the year at $52.6 billion.
What about their ability to borrow more if needed? Liquidity, future obligations.
They mentioned having $10 billion unused on their revolving credit lines and being compliant with debt covenants, so they seem to have access to more funds. But the report also flags enormous future cash requirements, like $146.2 billion in purchase obligations commitments to suppliers, and that $54.4 billion in total long-term debt, including what's due soon.
You mentioned the big stock issuances helped fund things. What else does the report say about shareholder value? Dividends, buybacks, future plans.
Well, those big capital raises the $18.2 billion from common stock, $5.7 billion from the preferred stock. Those were the main actions impacting shareholders directly through raising cash. They also detail the planned all-stock acquisition of Spirit AeroSystems.
Right, bringing them back in-house.
Exactly.
Oh.
Valued around $4.7 billion equity, expected to close mid-2025. That involves swapping Spirit shares for Boeing common stock. The report is quite clear here. Both the stock issued for Spirit and the potential future conversion of that preferred stock into common shares could dilute existing shareholder stakes.
So more potential dilution down the road. Anything else?
They mentioned using common stock instead of cash for their 401k contributions, and they declared $72 million in dividends, but that was on the mandatory convertible preferred stock in December 24. Paid in Jan 25. No mention of common stock dividends or buybacks as current actions in the text provided.
Okay, so wrapping this all up, how does the report frame the path forward? What's the outlook they present?
The CEO message reiterates confidence in their plan, their people. Focus on those fundamental changes, stabilizing, improving culture, rebuilding trust. Future prospects really hinge on executing that massive backlog, right? Turning orders into deliveries and cash.
And the Spirit acquisition plays into that.
Presumably, yes. The idea is bringing a key supplier back in-house gives them more control over a critical part of the supply chain, potentially helping stabilize production. They are still focused on ramping up production rates, but the report is candid about the ongoing challenges: supply chain issues, fixing production problems, hitting those tricky certification timelines for the new variants.
And the financial picture going forward.
They expect CapEx to grow in 2025, so continued investment is needed. And the report underscores the significant financial risks that remain: potential future losses on those fixed-price defense jobs, ongoing supply chain vulnerability, managing those huge pension obligations, environmental costs, customer financing commitments, and fundamentally, the need to get back to sustained profitability and positive operating cash flow.
So we've just walked through these key excerpts from Boeing's 2024 10K. It paints this picture of, well, a company with truly immense potential. That half-trillion-dollar backlog speaks volumes, but one that clearly wrestled with profound operational and financial headwinds in 2024. That nearly $12 billion in cash used by operations, combined with the huge $10.7 billion inventory buildup, it just starkly illustrates how severe the production and delivery problems were, even as they managed to raise billions externally to navigate it.
Absolutely. What this filing really drives home is that direct, painful link between quality issues, production hiccups on the factory floor, and the just staggering financial fallout that ripples through a business this complex and long-term. When production slows or rework costs climb or supply chains falter, it doesn't just mean late planes. It blows multi-billion-dollar holes in cost estimates for fixed-price contracts, forces massive balance sheet adjustments like that inventory surge, and ultimately leads to billions in losses and negative cash flow, even when underlying demand for your product is incredibly strong.
Which leads to a really important question for you, the listener, to think about. Given the company's stated absolute focus now on safety, quality, culture, and people, laid out right alongside the very concrete, very costly financial consequences of production snags, inventory pileups, program losses, and that significant cash burn detailed in this report, what does this filing ultimately tell you about the sheer scale, the complexity of the operational and cultural turnaround that's needed to finally consistently convert that half-trillion-dollar backlog into profitable, predictable performance?
It's certainly a monumental task ahead.
Thanks for joining us for this deep dive.